Ladies and gentlemen, welcome back. It's another beautiful Wealth Wednesdays. Happy to work here with you. We're going to be going through a very interesting topic here today, one I'm excited to share with you. Today's topic is, as you see on the screen, advanced wealth building strategies. Uh, Now, leading up to this, we've covered step by step what you need to do to get yourself to the point where you're um, actually taking a real go at your finances, right? So we started with things like your budgeting, building out the basic understanding of all of those steps, moving on to, of course, building a baseline understanding of investing, risk management, and now we just want to look at some advanced wealth building strategies that we believe would be very beneficial uh, as you develop this game plan. So let's get started. So, what is the importance of taking it a step ahead when it comes to your financial planning, your long term retirement planning, and executing it appropriately? Well, first of all, it goes beyond your basic investing. Right? Your basic investing is tackling the essential things you need to do to make sure you're keeping up with your peers and making sure your family is well taken care of. When you get those things taken care of, as anyone in the world where we build does, you tend to look for what the next stage of that is. Right. So what we're looking at here today is when you've taken care of your baseline budgeting, when you are in a position where you started to invest, uh, what then are some of the more advanced things you could do uh, to build up that nest egg, to build up that generational wealth, as they say. So the reason is higher risk, or sort of better said, higher returns as a result of taking on more risk in this more advanced capacity. But then also, it gives you better access to risk management in the sense that the more capital you're able to accumulate and take on, the more you can manage the risk thrown at you, right? So it also lastly gives you the ability to think outside the box from what your peers who have not taken on those responsibilities can do. Right? You get access to different asset classes at this stage that actually help you accelerate your wealth building. So the first thing we'll talk about is real estate. Now, real estate is an interesting one, and we have a very wonderful class tomorrow actually with Jennifer Barif. I hope I pronounced her last name appropriately. But Jennifer will also be a very good resource with regard to getting more into real estate and understanding where the asset class provides value for you. Now, this is looking beyond just your single family home, and this is starting to look at ways to leverage credit within that asset class to build either more doors, more rental cash flow, or maybe you're a flipper, right? There's different ways to accumulate wealth within the real estate space as one section of your diversified portfolio. Now, the other part of what real estate provides for you is the tax benefits it provides for you. Um, Most great real estate investors will let you know that the more you get through, the more you do within that space, the more you own, the more you're able to leverage it from a tax perspective. Right? So, getting a better handle on real estate investments and how to leverage credit within that will give you great tax benefits. Uh, I'm going to throw in some case studies here for you guys to check out in your spare time. Sam Zell is a very well known, well esteemed real estate investor. Look into his history and where he came from, his philosophy, it's a great way to understand real estate. Of course, he's grown to a point where he can do this at a higher capital level. But again, it has to be said that no matter what kind of investing you're doing, you have to have a philosophy that guides you and keeps you on a narrow path. But through it also a pro tip there: consider the cap rate and cash on cash return when evaluating properties. I think really what that says is do your due diligence. Now, entrepreneurship is a very interesting path to either passive income or, depending on how you approach it, active income over time. Right? Um, Even while you work your 9 to 5, when you think about your budget, especially in your younger days, if possible, and even in your irrespective of your age, frankly speaking, your goal should be to segment your income in a manner that you take care of your current needs, yes, but there should be some space within that for what I define as just enterprise, right? Your ability to generate value on your own without committing your time to someone else, right? So leveraging your time on your own based on your own skill sets to generate value. So personal enterprise is really what I call that. So some of your income really should be dedicated to something like that. And so as you grow within your 9 to 5, what it allows for you to do is continue to scale out your personal enterprise. Again, I'm saying this not from the perspective of, oh, you can make $1 million. No, the goal is slow build through your personal enterprise. You think to yourself, what do I know that I can generate value from? Right? The internet has made it very, very easy for us to find different ways. Upwork is a great resource for folks who have different skill sets who might not even know that they're monetizable. You check on there, you might find something. Right? So the goal again is personal enterprise. How do I generate value from myself? Evaluating first, what are the things I know how to do? What do I know how to do? Right? What have I done in the past? What did I do when I was growing up? What are some little skill sets that I might even pick up over time? I might have dropped it off. I might have dropped it off to the side. But using a lot of free resources, things like Coursera, you can create new value within yourself or update already available value to improve your personal enterprise. So the goal is, while I'm doing my 9 to 5, while I'm working my job, I also need to find a way to use that income, use a portion of that income to generate personal enterprise. So we talked about earlier the 50-30-20 in a previous class when we talked about budgeting. We talked about the 50-30-20 breakdown in terms of breaking down your income. Now, we said 50% of the income towards your needs, 30% towards your wants, and 20% towards your savings, all right? You can flip that around and you can decide that 10% of your income is going to go towards saving for your personal enterprise. And so you reduce that 30% of wants to 20, and it becomes a 50-20-20-10, all right? 50% to your needs, that could also be less, all right? 20% to your wants, 20% to your savings, and at the very least 10% towards what's described again as your personal enterprise. Elon Musk is a great example of this. You see, through all his business endeavors, he's leveraged what he knows, but also leveraged having smarter people around him. So the relevance in this conversation is, one, using your network to further enhance your personal enterprise. So if I know how to do something and I have friends who know how to do something else, how do I leverage personal enterprise, my personal enterprise and theirs, in order for us to both make extra money? All right. So using the network around you, but then always looking ahead. And the last thing he did, which I believe is the best way to try and figure out how to um, how to develop your personal enterprise. The last thing that he did is he's always looking for a problem to solve. Right? So don't lead with, oh, I'm trying to make money, or oh, I need to make money, etc., etc. Instead, you want to lead with, what is a problem I can solve, or what is a perceived thing that has a solution that I recognize I can provide, or I can gather resources together and work towards one step closer to that solution. Right? If I can move the needle even one step, how do I monetize that? Okay. Now, speaking in the sense of what we're saying here, startups versus acquisitions, the pros and cons of building versus buying a business. Now, this is speaking to, you've gotten to the point where you can decide whether you want to build a business on your own, or you've built up enough capital and you want to look at actually buying into a business. That could be a franchise, right? That could be a friend or a family member that you see them have a business and you want to buy into that. So a private business. It doesn't have to be that specific, but I'll just give an example. So those are examples of buying into a business versus building one over time. So uh, building a business is the personal enterprise I've discussed so far. And so the other alternative to that is being able to buy a business and then leveraging what that provides. We've seen in a lot of communities, such as the Indian community and even the Jewish community as well, where an individual works a 9 to 5 corporate job, but they own a small, for example, a small yogurt shop, right, or a small sandwich shop, right, that they have someone working there and managing that business, and it's a side income. So that's a situation where you can build up enough capital to buy into a small franchise, have that as alternative income or separate income or passive income while you continue to work your 9 to 5. Right? Now, as you build these and as you try and figure out what is best for you, you also now start to come up with a problem of understanding, okay, how do I scale this little baby of a business I've built, right? Without it interrupting either what I'm doing right now, or maybe it's time for me to decide I should transition to work in this business full time, right? We have the benefit of things like AI. We have the benefit of um, gig economy to be able to automate and outsource as much of this as possible. I'm sure you can see even from the graphics up here, I use AI to build out my PowerPoints, right? I build out the PowerPoint, and then for it, I wanted to figure out all the graphics and all that stuff. So I build out my PowerPoint and I throw it in there, and it produces me something I can present for you guys, right? Shout out to Gamma, and to sponsor me. But my point is, you can automate and you can outsource a lot of the work that it takes to build out a small business as a passive source of income. So we don't need to be scared of those limitations anymore. And so the goal is, as I work my 9 to 5, how do I carve out a portion of the income I generate there, in addition to my personal development, my personal enterprise, to produce value. Again, if you have any questions, certainly just throw them in the comments and I'll see them and I'll answer. I'm so excited for a lot of what we've been talking about today. All right. Now, what are alternative investments? Now, when we spoke about investments last week, we talked about diversification in terms of the overall content of your portfolio. That is your stocks, your bonds, your real estate, yourself as your most important asset. And then understanding the distribution of correlation across that. Jordan Zachary, if you attended last class last week, Jordan Zachary explained what correlation means, right? The relationship between two assets, or really the relationship between two items, In this case, we want the least amount of correlation, which means the least amount of relationship between two assets within the portfolio. What this allows for is as your portfolio takes on volatility, as it takes on the ups and downs of things, it allows for you to really weather the storm at those different points. Your entire portfolio, your entire different class of assets, or different asset classes, sorry, don't all go down at the same time. So this is again, our group contains people of various wealth classes. So this speaks, of course, to those with enough capital to play in this market. Right? Alternative investments are something to be taken very seriously. They do have a lot of risk to come with them, but at the same time, if done appropriately, they have a lot of return to come with them. For those of you who invest internationally, if you invest in Africa, for example, you find a lot of project-based investments, a lot of agricultural project-based investments. It could be 6 to 9 month time frames, and you have something like a 20% return or 30% return, right? It sounds high, but then you think about what is the interest rate or what is the inflation rate in that country, right? That's going to play a lot in terms of the kind of returns you expect in that country. But if you do that from here, you're giving yourself some arbitrage. The important thing to say within that is there's a lot of due diligence that comes with alternative investments, but if done appropriately, you could get a lot of return from it. So consult with your financial advisor, consult with your CPA before taking on these things, but also, of course, do due diligence by yourself as well. Um, so now, my favorite thing, I think I spoke on this 2 classes ago. Um, my favorite thing is OPM, right? All people's money. Leverage OPM. Nipsey also said it. My boy Currency said it. OPM. But be responsible with it, right? We've talked about in, I think the first class when we spoke about um, credit, we discussed that it is something to be used almost like an investment, right? Every time you're tapping into credit, there should be the question of how does my future self gain from this? How does my future self benefit from this? Because it's either a debt upon your future self or it's an investment for your future self. All right. So this is how you this is the thought process you use to distinguish between good debt and bad debt. Okay. Now, for those who are investing in the stock market, as you get deeper into your stock market investing, margin accounts and utilizing things like leveraged ETFs are a way for you to access additional capital or additional capital or take on additional risk, depending on how you look at it. But the point is, that's your version of leveraging debt or leveraging um, the house's money. Now, please understand that the risk that come with this is severe in terms of how it could affect if things don't go your way. So use these things responsibly or not at all, and speak with your advisor to give you guidance within this. But I think the key component here to really take away is identify what is good debt versus bad debt in terms of its application in your overall portfolio, right? Not all real estate is always good. For example, you could look at a beachfront property, beautiful, $1 million, and you go sell everything you own in order to raise the capital because you think your credit is there and you think I'm just going to buy this, hold it, and then sell it. And then you do that, and you're saddled with significant yearly income, yearly estate tax, tax on the home, as well as, of course, repairs and maintenance and everything else that goes along with it. All right. So if you don't think about that investment from the point of view of the full length of time it's going to survive in your hands, or better said, the full gamut of areas that you're going to have to manage to make sure that the investment fulfills itself, if you're not able to gauge that, you will hurt yourself, right? So understand this and leverage the professionals around you. Leverage your accountant, leverage your financial advisor, leverage your lawyer. Make sure you speak with these individuals and make sure that they give you guidance before you take any unnecessary decisions or before you take any decisions, frankly speaking. Okay? Donald Trump was the example I wanted to use here. I know. But he's an example of an individual who has leveraged debt extremely in order to build assets, right? No matter how you want to slice the guy, the the actual properties that are owned, even if those are liquidated, those alone are significant value. So, however he got them over time, the point is leveraging debt in order to get them. I know it's a terrible example, but I thought it was funny. um, VP Tiffany speaks on taxes every Tuesday. I'd always encourage you guys to tune in for those classes. Um, she's a wonderful resource in understanding the implication of taxes in this case. Um, but um, I'm trying to limit the way I speak about taxes because I'm not a tax professional. I'm a financial professional. I'm a financial advisor by trade. And I think it's always important to speak to what you know. So I'd always say speak with Tiffany, reach out to Tiffany if you have questions on tax strategies. Now, with regard to the type of investment accounts to use in order to manage your um, your taxable income, um, this also applies to understanding what the full strategy is around your investments, and then understanding how you want to distribute those investments in the future. A lot of that is going to help you understand what vehicles and what accounts you want to use today. So as I said right there at the bottom, speak with a tax strategist, speak with a CPA. They are the best folks to give you guidance in terms of making sure you're appropriately allocating your dollars to the right accounts. Ah, more of my space. Okay, so asset protection with regard to looking ahead and thinking about, do I need a revocable or an irrevocable trust for my assets, right? Of course, that has to do with understanding what your current assets are, understanding how you want your family to access it, and then understanding the implication tax wise when you're no longer here. All right. Speak with an estate planning attorney to make sure that they're giving you proper guidance, even if it's just for your will and power of attorney. Make sure you have those properly worded. And this is something else I see with this internet age. People tend to just download it from the internet. Each state has their own regulations. So consult with professionals who are within those states to make sure you're getting the best advice, especially for things like estate planning. Okay? So make sure that you're speaking with an appropriate estate planning attorney to properly title your accounts, properly build out your trust, because these things will be affected. God forbid, when you pass away, you don't want your family confused about the intention with all these assets that you spent so many years building up. You want them to know that you were confident enough in the game plan that you already have a plan set in there. You sounded like a mouse. Most of the top financial and economic minds that I follow, in my opinion, they study more so behavioral finance or behavioral economics. Um, it helps you understand. It helps you first of all recognize patterns, the patterns of the population around you or the people around you. But then it also helps you recognize when you're following the crowd and when to go against the grain. Right? Behavioral finance also helps you understand how to be patient and why you should be patient in your approach. So understand that we as humans, we have certain biases, especially towards things like pain, towards things like the fear of missing out, right? And understand when it is those primal instincts that are driving you versus real intent and a real game plan. As we said last week and 2 weeks ago, every single asset class comes with volatility. Volatility is the brother or child of risk. I don't know which one to give it, but one comes with the other. You can't have volatility without risk. Or sorry, you cannot risk without volatility. Right? That is in there, and that is there in where the risk come from. So when you start with a plan, it helps you stick to it because you're giving yourself guardrails, right? You understand that anything beyond these are emotional reactions, especially at the most volatile of times. Ray Dalio's Principles is a fantastic book um, to understand market psychology. Ken Fisher also has some wonderful books. Debunkery is a great one, but it's very simple to read as well. These are great books to really understand and have a good grasp on the way people think about money, the way people think about risk, uh, and the way people deal with fear when it comes to these topics. So, folks, thank you so much for joining us today. I don't see any questions here, so I will go ahead and wrap up. I do really appreciate the time you spent with me. I hope this was engaging and informational for you, and I look forward to the next class. Again, every Wednesday we have Wealth Wednesdays. I'll include my all my social media in the post, as well as my website and my Calendly for you to schedule any consultations should you feel appropriate. Be blessed.